Good morning, everyone. Welcome to this FundRock Hedge Fund seminar, where we will have the opportunity to hear from some of South Africa's preeminent hedge fund managers and experts. My name is Adam Bulkin, and joining me today will be Ofri Kalon from Visio Fund Management, Gareth Montano from Korean Capital, and MJ Dipinar from Fairtree Capital. Before hearing from these three gentlemen, I would like to thank BCI and FundRock for the opportunity to discuss this topic with you and to introduce Edify to you and explain why we too are strong advocates for the use of hedge funds. If I could have my presentation, please. Thank you. Great, thank you. So Edify is a relatively new DFM specializing in hedge funds. We manage multi-asset and offshore portfolios too, but we come from a hedge fund background, and we specialize in management of hedge funds. We run portfolios, model portfolios of hedge funds, and we've been managing them for quite a number of years. And what I want to do, show the audience, is the real actual effects of using hedge funds and how powerful they can be, and just why we are strong advocates of them. If I could have the next few slides, Olga. Yeah, that's us, the FM, and the next slide is just who's on our team. Thank you. That's myself, and I'm joined by Chelsea and Christian Janssen van Rensburg. Thanks, Olga. Next slide, please. Yes, thank you. Right, so this is the real life experience of our model portfolios. We've been running them for a number of years, 5 years, in fact. And so these are the actual returns of our model portfolios. And we've used a simplified methodology just to show how powerful the inclusion of a model portfolio is in a long-only or regular multi-managed portfolio. What we've done is we've modeled a balanced portfolio, which is simply 70% equity, 30% bonds, just for the purposes of illustration, to show you what those long-only betas, those long-only asset allocations would have achieved, and then what our actual live model portfolio results would have been to improve the risk and return of those portfolios. So you can see the Edify Defensive Hedge, which is our defensive model portfolio, and the Edify Growth Hedge, which is our growth model portfolio of hedge funds. Those are just hedge funds on their own, our blended portfolio of hedge funds. You can see up on the efficient frontier, producing the best risk and return. And then you can see what we've done with a stable portfolio and a balanced portfolio, as I explained, with a 30% hedge allocation. And then you can see what the bond index, a normal stable portfolio, normal balanced portfolio, and Cat Swix would have done over this period, which is up to most recent reporting period for 5 years from 2019. So you can immediately see the power and effect that including hedge funds in a long-only traditional portfolio have, and on their standalone basis. Next slide, please, Olga. These slides will be made available to the audience, but I think I just wanted you to focus on the bottom line of each of these, the Sharpe ratio. And you can see again that in terms of risk-adjusted returns, if you look at Cap Swix on the left column, the All Bond Index on the next column, and so on, you can see that the Edify Growth Hedge portfolio has by far and away the best Sharpe ratio, and then combining it at a 10% weighting or a 30% weighting with a balanced portfolio, which, as I said, is we've modeled just on 70% equity, 30% bonds, also increases your Sharpe ratio. Both result actually obviously meaning an increase in return and a decrease in risk, which obviously is what all investors should be and would be looking for. And the same would apply for our defensive hedge portfolio. In fact, a greater Sharpe ratio. We're now looking at the bottom table where the Sharpe ratio for the Edify defensive hedge model portfolio live track record is 1.73. And you can see that adding it to a traditional long-only portfolio dramatically increases the Sharpe ratio. 30% allocation to the defensive hedge increases the Sharpe ratio from 0.25 to 0.48, almost doubling it, and allocating 10% increases it as well. So, the important point is just to show that, everyone talks about the power of hedge funds. Here you can see the actual effects with a live track record from January 19 to April 25. Thanks, Olga. And this is just a graphic illustration of that. As we all know, the power of compounding returns. If you slowly, incrementally increasing off a higher base, not taking those drawdowns, then you can increase your returns cumulatively quite significantly. It's the same idea. All of those models that I've shown you, the Edify Growth Hedge on its own being the uppermost line, and decreasing the allocation to hedge funds incrementally, so from 30% to 10%, and then just a balanced portfolio and CPI. Thanks, Olga. And the same thing you can show for the defensive hedge, a very similar idea. I think for us, we're quite proud of the fact that you can see how stable, how steady that top line is. And that's going to be important in the coming slides, which I'll show you with respect to living annuities as we move on. That's that point I made about living annuities and about drawdowns from portfolios is extremely important when looking at the drawdowns that a hedge fund portfolio has achieved. So here again, we've used our defensive hedge portfolio with the dark line with the lowest drawdowns, and you can see that in periods of extreme market stress, just how effective hedge funds have been in terms of on a standalone basis and in terms of including in other portfolios. And that's the most important thing, I think, for investors, particularly those focused on not wishing to experience all of the volatility and the drawdowns that traditional and especially equity markets can bring. You can just see how effective it's been in terms of reducing that drawdown. Next slide, please. So the power of hedge funds is to symmetry. So as much of the upside of a particular market as one can get, but as little of the downside. And here it's aptly illustrated with our Edify Growth Hedge versus capped SWIX. So you can see over the whole period of live model performance that in positive months where the capped SWIX has on average generated a return of 4%, that the Edify Growth Hedge has captured a little over half of that. And in down markets where the average return is a little bit below -3%, that the Edify Growth Hedge portfolio has captured just over 1% of that, with the result that over all periods, the average positive return of the Edify Growth Hedge Fund portfolio has been far superior to capped SWIX. And that's why we see in those cumulative models just how powerful it is to compound steadily over that period, avoiding those drawdowns, avoiding that volatility, and so outperforming traditional long-only market beaters. Thanks, Olga. Again, a powerful illustration is the most severe drawdowns that the SWIX has experienced since 2019. Again, the important part that we want to impart to you is that DFMs and hedge funds like ourselves have been running a very long time, and we can show you a real life market stresses that have occurred and just how hedge funds have been able to manage these unforeseen events. So you can see that, for example, in the March 20, Feb 20 periods that would have been during COVID, the extreme market stress that the capped SWIX had over those particular months, and how a growth orientated hedge fund portfolio like Edify Growth Hedge managed to navigate those extremely volatile, severe drawdowns, which were unforeseen, and I think that's important. In August 23, for example, even though the SWIX was down with quite a severe drawdown, our model and many other hedge funds actually generated positive returns, and likewise you can see for April 2022 and July 2019. So those are the important points where the market is underperforming significantly and you're able to control those drawdowns. Thanks, Olga. And I think that that's the most, probably one of the most effective uses of hedge fund portfolios, precisely to that point, is this idea of sequence risk, of controlling for those drawdowns, especially when one is having to draw down on a portfolio. So you can see, again, we've modeled a stable portfolio, 65% all bond index, 35% capped SWIX, as a stable portfolio, and the returns are purely of Edify Defensive Hedge, and you can see over that period how the downward volatility, the drawdowns have been controlled. And this is important. Next slide, Olga, when we look at actual drawdowns. So here what we've done is we've said, okay, if there was a client drawing down at 7.5% per annum in their living annuity, obviously a fairly aggressive drawdown level. And unfortunately, as we all know, many South Africans retire without sufficient savings, and they're having to face the very difficult decision of investing in an aggressive portfolio because they need they need to grow their assets, and at the same time, because they're investing in an aggressive portfolio, having to face this volatility and possible drawdown risk in their portfolio because they have to invest in assets such as equity. So they're in a catch-22 situation where they have to increase their risk, and while they're increasing their risk, having to draw down quite aggressively, with the result that one can run out of money if one is unfortunate as to the timing of the market in a rapid manner. And we found that hedge funds are an extremely effective tool in enabling one to control for that drawdown risk, control for that sequence risk. So here we have a graph of the stable portfolio drawing down at 7.5% withdrawn monthly, and the Edify Defensive Hedge portfolio drawing down 7.5% per annum drawn down monthly. And you can see over this, again, this live track record, just how effective it would have been. In fact, the Edify Defensive Hedge portfolio actually kept up and in fact grew over inflation over this period, despite this continual drawdown. If one thinks about the bucket methodology that some financial advisors use, where they would withdraw a certain portion for the year and place it into cash, the problem with that type of idea is that one can't grow that bucket. It's sitting in cash. And so what using a hedge fund portfolio like this does enable one to grow the entire portfolio and be able to control that sequence risk. Thanks, Olga. One other thing to mention when we're talking about living annuities is that the regulation, of course, allows one to invest fully in hedge funds. Only in regulation 28 portfolios, discretionary, will there be the requirement that you can't allocate fully to hedge funds. We'll get into that later in our present in my slides. Just very quickly, and I don't need to spend a lot of time about this, but I think the important thing about hedge funds is that they need to be understood. There's a lot there. There may be risks in hedge funds. Korean capital, I think we'll talk to some of that. And so one really needs to understand what one is getting into in terms of each and every hedge fund. You have to really understand what each strategy is doing, the drivers, the risks, the leverage that each fund is employing. For example, we find hedge funds in the market neutral space called market neutral hedge funds, which can have a net long equity exposure of 50%, and at the same time, a fund described as a high growth fund. So one in an entirely different category with a very similar net long exposure. So just by investing in a market neutral strategy, which one would think would be very defensive, have no market directionality, one in fact is getting fairly aggressive market directionality, fairly aggressive exposure to equity beta, and one has to understand all of these things, really delve into them. You can't just rely on the track record. Thanks, Olga. So for us, we want managers in whom we have a high conviction, that we know are dependable, and we understand the risks and the return drivers that they are taking. The great thing about hedge funds is that each manager is doing something very different, and so the power of diversification is in fact far greater in hedge funds than it is in other asset classes. So for example, if you're blending a portfolio of equity funds, the correlation between each fund, no matter the variation in style, and various risk premium that any equity fund will be attempting to exploit, is the correlation between them is still going to be very high. They're all going to act in a very similar manner. One would expect the correlation to be probably at least in the region of 85%, 0.85% for those managers, perhaps a little bit low if there's a very different manager. But the important point is, the correlation between them, they're all doing the same thing. They're all investing in equities, and it's just which equities you're getting. So you're getting your equity beta plus hopefully a bit of alpha. The interesting thing about hedge funds is that because each of them is doing something very different, no matter which asset class they're in, using different leverage, different instruments, different directionality, there really is a great power in being able to do a blend of hedge funds where the diversification benefits can really shine through. Olga, next slide, if I can just demonstrate that. You can see here the different correlations. I'm not going to spend too much time, but the important thing you can see, for example, negative correlations within each of the portfolios, and very low correlations. This is our defensive hedge model, and each of the underlying managers in that, and just how uncorrelated they are. They're all doing something very different. And the same in the next slide, you'll see for our growth hedge. A little bit more correlation, but in some of the assets, because one is trying to get higher growth, but overall, very, very low correlation. And what this helps, you'll see in the next slide, is the ability to create a really nice efficient frontier when looking at the blend. So you see there the consistency over 1 year and 5 years of the edified defensive hedge portfolio. It remains where it is, even though the managers of the portfolio are moving around a little bit in terms of their risk. That diversification, that correlation effect, means that your outcome of your portfolio, of your blended portfolio, actually remains very stable. That's interesting. It doesn't matter whether the managers are moving around or not, and obviously that changes to some extent. Like looking at, for example, manager 2 in our 1 year versus our 5 year plot. That's the same manager. They moved around a little bit in terms of their standard deviation relative to others, but and themselves. But the important point is, because of this, the differences, the variation that each underlying manager is doing, the blend through the natural diversification benefits is so much greater than a simple long-only traditional portfolio where all of the managers are really doing very much the same thing. And the other great thing is that one can use very aggressive managers like Manager 7 and Manager 4 in this example, and still achieve a very, very low a very, very low volatility, risk-controlled portfolio. So there's great benefits that one can enjoy if one is skilled in blending hedge funds together. Thanks, Olga. I don't want to spend too much time on this. It's the growth hedge portfolio. It's the same point. One can see that one has achieved, we have achieved, a better return for lower risk, generally through the blend. So really increasing that Sharpe ratio and that efficient frontier. Yeah, I've spoken a little bit about the advantages where you can utilize hedge funds. As I said, in living annuities, actually there's no maximum utilization limit. In discretionary investments, no maximum utilization limit. Unfortunately, for tax-free savings accounts, the regulator has seen fit to not allow hedge funds. You'll have to ask them why they thought that was a good idea. And in pre-retirement, up to 10% in hedge funds altogether, up to 5% in a single hedge fund of funds, and 2.5% per individual hedge fund. Just on that 2.5% per individual hedge fund, if you use a model portfolio like ours or a fund of hedge funds, you can add many more hedge funds. You don't have to put like 4 hedge funds at 2.5%. So those diversification benefits that I mentioned and the way that you blend them can become a lot more sophisticated if you use a vehicle like a model portfolio or a fund of hedge funds. But you are able just to allocate to a single underlying hedge fund at 2.5% each. Thanks, Olga. Yeah, I've spoken about this, and then I think we have my final slide. I'll go after this. Sorry, our availability. You can get this from the slides later on. But suffice to say, we are on the major platforms. And then just your last slide after this is just to understand the regulation. So it's important to know, and I'm sure everyone does, that advisors require the ability to advise on hedge funds. They require, in terms of category 1.26 participatory interest in a hedge fund, but that advisors without that license can still utilize hedge funds in the Allen Grain 91 and Glacier platforms using specific underlying life products. Unfortunately for Allen Gray, they don't allow hedge fund allocations in that. If you don't have your 1.26 participatory interest, but for 91 and Glacier, there is some ability to still utilize them within life products. For example, living annuities, endowments, and RAs. Thank you very much. Those are my slides. I really appreciate the attention, and it gives me great pleasure now to introduce Ofri Kalon, who will be taking us through one of the longest standing and excellent return hedge funds in our market from Visio Fund Management. Thank you very much, Ofri.
Great. Thank you, Adam. And thank you to BCI for allowing us to present. Let me just share my slide. Can you see that okay on your side, Adam?
That's perfect. Thanks, Ofri. Go ahead.
Cool. Thank you. My name is Ofri. I've been at Visio for about 19 years now. Visio started in 2003. As I said, we were one of the first hedge funds in South Africa. I think when we talk about hedge funds, because of the series and movies that are out there, I'd imagine that this is what people imagine happens in a hedge fund. From our point of view, it feels more like something like this. The goal of our hedge fund is to generate an absolute return, and regardless of what's happening in the environment. This is a very similar chart to what Adam showed you earlier. On the left, you can see that in the up months, the hedge funds don't do quite as well, but on the down months, they protect the downside. So what this results in is a steady increase, compounding returns with very little volatility. In this chart, you can see the rolling 12-month correlation to the market. The average here is about 0.5, and that in a way kind of tells you that the way that we generate returns is quite different to the way that the index returns come about. So a little bit about why hedge funds behave this way. Hedge funds have flexibility in the way that the mandates allow us to be positioned very differently for different environments. So if we were nervous about the environment and we want to be at 20% net equity at a particular point in time, we can do that. We're feeling comfortable, we're feeling bullish, we can be at 90%. But we can also be across a lot of different asset classes. So we can be in fixed income, we can be in commodities, we can have quite a lot of flexibility between offshore and local. And that allows us to play where we see the opportunities are. The hedge funds are not benchmark cognizant. We're looking for absolute returns. So the portfolios are built of our best ideas and where we have high conviction. Fundamental analysis is also the basis of everything that we do. But as I'll try to show later with a couple of examples, there are different ways to express those. Some of the hedge funds are not daily liquidity, but monthly liquidity. And one of the advantages of having something like that is that in volatile times, and there is panic, it kind of prevents withdrawal at what might actually be a very inopportune time. On the right here, just wanted to give like one of the examples. It was one of the best opportunities that we've seen, in our time, is during the global financial crisis. Going into the financial crisis, we had quite low equity. It was probably between 20 and 30%. But then we had the opportunity to invest in corporate bonds, very good corporate bonds in companies that we know really well, like Old Mutual, Standard Bank, Consol, Piedmont. And those bonds were trading at 35% of face value. If you think that some of them were, the annual coupons that we're paying was like 8 on 35, it's way over 20% of cash yield that you were getting on a bond. It was an amazing opportunity. We put about 20% of our funds into corporate bonds at that stage, and over the next couple of years, those reached back to par, back to 100, where they were trading before some of them we held to maturity. It was still like it still made sense. A more recent example was during COVID, when the Sasol US dollar bond traded down at 55% of face value. Now, if we look at some practical examples, some recent examples. The first one is Apple. We appreciate that Apple is an amazing business. It generates very good returns. It has a loyal but imprisoned customer base, and it is the gatekeeper for anything that is installed on its devices. But there are some headwinds. First, it's quite expensive. It trades on 28 times forward PE, so there's very little room for error. The mobile phone market is saturated. Devices are lasting longer, and we're seeing a lot more competition. Maybe not so much in the US, but out of the Chinese brands into the rest of the world. The upgrade cycles are getting longer, and there's less difference between the one generation and the next, but prices do keep increasing all the time. The other issue is the AI strategy. Apple has been very late on that, very late to start, and we think that they might actually be dependent on, an OpenAI or a Google for that product. But the biggest headwind that's coming, and something that's happening in the courts currently, is the App Store. There's the battle with Epic, and that could lead to much lower take rate on the App Store. The App Store is a massively profitable part of Apple. So how have we played it? We bought a put option on Apple for 10% of the fund. It's a naked put. We don't actually own Apple stock, so this is just a position to give us exposure should our thesis play out. The put cost of 7.5%. It expires in 6 months' time, so the cost to the fund is 0.13% per month. If we look at the lower graph, we can see that there's two kind of benefits to the structure. First, there's a high correlation between the put and the VIX. The VIX is the fear gauge. So when there's panic in the market, you can see on the blue line, the VIX went from roughly 20 to about 50. And the put option went from just below 10 to just over 30. This happened over what was Liberation Day, and this created a very positive mark-to-market to the fund. It wasn't the intention of what we wanted. We weren't expecting Liberation Day to be what it was, but it just kind of shows the protection they can provide in volatile times. The second chart, the second benefit will be if the thesis plays out, and an Apple stock does de-rate to where we think it should be trading, and the value will accrue to the put option. The next example is on NVIDIA. We believe we're very early in the AI story. It is one of the themes that we really like for the next 5 to 10 years. It's going to change the world. I mean, at the beginning, it starts with these agents, with these AIs that you can interact with, help you with work, with learning, and at some point, then it becomes also into robotics, whether it's going to be a personal assistant in the home, autonomous driving, that kind of thing. So we think it's a super important technology. It is important in the sense of the hyperscalers. So you got OpenAI, Meta, Anthropic, Google, all of them fighting it out. But you also have a political angle to it, where it's very much like America versus China, and they are in this race. They believe, we're not sure whether we agree with this, that once you reach a certain level of intelligence, it starts feeding on itself. It starts teaching itself, like the way that AlphaGo did. And once you reach at that stage, it becomes this runaway reaction, and intelligence just goes up exponentially. You want to be the first one to reach that, because if somebody else reaches that before you, it's going to be very, very hard to catch up. That's why we're seeing such massive investments now into infrastructure. Maybe at some point that goes into the application layer as well, but at the moment it's in the infrastructure space. So we were late on NVIDIA. It had already run quite hard, you know, when we wanted to buy it, but we were pretty confident about the longer term. But we wanted to protect the downside if we were going to take a position. So what we did is, like in Apple, but we own the stock, but we wanted to buy protection, so we bought a put option on it. The put option was quite expensive, so we funded some of that put option by selling a call option. Essentially, what that did is we buy NVIDIA at 89. We have protection at 84. If it drops below that, we don't lose any more money. But if it goes above 107, we don't participate on the upside. So we can play in between that. In this particular case, we were quite lucky that NVIDIA dropped after we bought it. And the reason why we were lucky is that the price of the call option dropped quite a lot, because the difference between the share price and the call option increased quite a bit, and gave us an opportunity to buy a call option at a fraction of what we paid for it. And that removed the restriction on the upside. A couple of months later, we sold it. It was about a month later, we sold it in the mid 120s, and we are still involved, but not through NVIDIA, but more through TSMC. Another example is MTN. MTN, if you look at it over the last 15 years, the share price is flat. But in between, there were great opportunities to make returns. The problem, I suppose, with MTN is that a big portion of its business is in Africa. And Africa is a double-edged sword. The growth can be incredible. The margins are very good, but foreign exchange, regulation, commodity prices, like, can create really, really big headwinds. MTN, I think over the last, well, from our inception, has probably been one of the biggest contributors to returns in our fund. If we go through like one of our decision points, back in 2016, MTN was paying dividends out of debt. They built up quite a lot of debt in the center. And that was putting pressure on the balance sheet. There were other issues like upstreaming cash from Nigeria. That Nigeria is a managed currency, and the government didn't want to depreciate the currency because they thought that was going to create a lot of internal inflation. So they kept the currency steady, but the black market rate was very, very far away. It was trading at double where the official rate was, and that created a lot of it created an issue on the income statement, where the income statement and the cash flows looked very, very different. They started deviating away from each other quite a lot. And that was the reason why we actually went short back in 2016. We don't really look at income statement. Income statement can be manipulated, but it is about the cash flows and about the direction of the balance sheet. We like companies with much stronger balance sheets, that's how it played out over that period. Subsequently, you had new management. They fixed the balance sheet. They sold a whole lot of assets, and that was good. But more recently, like in 2022, Nigeria started doing it again. So you had a managed currency. The currency went from 400 naira to the dollar to 1,500 naira to the dollar. But they kept the peg for a very long time. The black market rate was trading at 1,000, and it was this massive tension. But when you looked at the income statement looked fine. You know, they got this wonderful earnings and wonderful growth coming out of Nigeria. But yeah, it didn't work out. So we went short again. We have subsequently covered. It's not actually in the chart, and we have gone long again. Okay. One more example is around bonds. So we do run a high yield bond fund. In a high yield bond fund, we often come up with some really good ideas. Find bonds are trading at 7 or 8% in hard currency yield. And at times when we're sitting on a lot of cash, when there's a lot of uncertainty in the market, it's not a bad place to park cash and earn the yield. But we often would hedge out the currency. So because we're hedging out the currency, not rand dollars, but the other way around, we get an additional yield of about 5%. So we can convert a 7 or 8% dollar yield into a 12, 13, 14% rand yield. And that's pretty attractive, especially when you're locking it in short duration type of bonds. You're taking very low risk. And yeah, we find it a very attractive way to generate some risk-free return, very low risk return. These are some of the examples. There are quite a lot of other examples, other ways that you can play it. I mean, I think something that a lot of people have spoken about that's quite well known is like Prosus versus Tencent. That gives you opportunities quite often. More recently, you would have seen something like a Pick and Pay in Boxer, where the value of the holding in Boxer for Pick and Pay was much higher than the Pick and Pay market cap, which essentially meant that the market was putting a negative 3-4 billion rand valuation on Pick and Pay, even though Pick and Pay is in a net cash position. Yes, it's making losses currently, but you know, there is a turnaround in place. So in those situations, you can actually buy the one, sell the other, and just play the discounts and expect the discount to start coming down over time. Activism, we do look at internationally, you know, like the way that what might be like the best practice that we think in activism globally. They can be pretty aggressive, but we take a much more constructive approach where we see opportunities. We do try to engage with boards and with management teams to get the most out of the shares, out of the investments that we have. So we do have constant engagement. Again, similar chart to what Adam showed earlier. Yeah, you can see the returns over time, see the volatility, the Sharpe ratios, what the drawdowns look like. And yeah, a hedge fund with Adam, steady increases over time, and they do outperform a lot of the benchmark with that strategy. So thank you.
Ofi, thank you so much. I am conscious of time, and we have a stop at 9:45, so I'm going to forego questions for now. Obviously, there are a lot of interesting things that you've spoken about. I'd love to spend more time with you on those, but to give time to the other participants, please may I bring in Gareth from Korean, and please take it away, Gareth. Thank you. Gareth, your slides are up. You are in mute.
Can you hear me now, Adam?
Yes, yes, can hear you. Go ahead.
Yes,
Thank you very
perfect.
much.
Thank you very much for your time. And once again, thank you to Olga and Tanya and FundRock for this opportunity to showcase Hedge. And, as stated previously, I think, very blessed in South Africa to have some unbelievable managers. So, to be able to showcase how good these managers are and, seeing some of the returns that have been shown, it really advocates, to have hedge exposure in your portfolios in whichever shape or form that you so choose. From a Korean perspective, I think what is critical and central to our investment thesis is diversification. Korean has been managing hedge funds. Our longest running hedge fund actually dates back to 2001. We've been researching managers in South Africa for that period of time and constructing portfolios, and the risk return payoff profiles are irrefutable. What we do differently, and our key differentiator, is that not only do we research and pick managers, we also play a more central role in the risk management of the fund, and side by side with selecting managers, manage a portion of the capital ourselves. Now, this serves many purposes. And I think most importantly is when it comes to diversification, there's always the vagaries of diversifications and risks, where the central tenet is that if you blend uncorrelated managers, you're going to get a great result. Sometimes manager styles can drift. Sometimes managers may not be consuming as much risk as the client or is expecting at any point in time. So what we do, and as part of our blending and management fee, is manage a portion of that money to ensure that at times we might need to mitigate risks, at times we might need to implement beta into the portfolio. What we really do believe is that, over time, investors should be rewarded for risk that they're taking on. So our job is to maximize diversification. And the thesis being is that it's risk mitigation, but not avoidance. So, if there are known risks, it doesn't mean that you shouldn't expose portfolios to risks, but how do we do it in a more efficient manner? How do we expose our portfolios and our clients' money to getting returns, but with a reduced or muted risk? And we do this in a number of ways. So first of all is, when implementing beta into a portfolio, it's trying to do it in a way where there's less downside and more upside, that typical asymmetry. I think position sizing is absolutely critical. Sometimes there is a trade that can offer great upside, but there's a lot of risk. Don't avoid it. Just put a small allocation to those portfolios. So this is where we play a big part in portfolio construction. And then further, looking to diversification is not merely around blending managers. It's looking at different asset classes, looking at different managers, looking at different styles, listed instruments, etc. So the diversification thesis is trying to source different ways of enhancing returns in your portfolio, and not just around a different manager. So how do we conduct this in our diversified portfolios? And starting is different instruments. From entering into the Korean portfolios, we have multi-manager, so different manager exposures. But importantly, you're getting exposure to different asset classes. So you've got your fixed income, your equity asset classes, but I think we're also one of the few funds in South Africa that's got exposures to commodities. So you're getting exposure to an uncorrelated asset class. And then again, because it's got hedge fund strategies, not only do you have exposure to commodities, but you've got long and short commodity plays within that construct. We've got exposure to listed instruments. Ourselves as well as our managers make use of options. Options, I think we've discussed this previously, but the benefits of having options in your portfolio is the ability to short in a more efficient manner, but also the ability to gear positions where you can get enhanced returns. And lastly, I think, in the last few years, I know that, structured products have come to the fore, but it's been something that we've been using for a long period of time. If you're comfortable with the bank exposure that you're taking on from a credit perspective, there are great payoff profiles that you're able to implement and extract risk premium, whether it be exposure to a specific sector or a specific geography. Structured products can give you great exposure and that asymmetrical payoff profile to implement into portfolios. So, taking all of these instruments, the next level is how do we implement that? And again, blending is sometimes, the vagaries of blending is that you can blend portfolios and managers who do similar things. So it is critical to have managers who've got different flares and different styles. Again, in South Africa, we're blessed with such differentiated skill in managers. We're a very obviously evolved market, but given our market construct, we've actually got a hell of a lot of good hedge fund managers who do things differently. So whether it be in a different asset classes where we've got some great fixed income managers and then great equity managers, there's also managers who are particularly good. Some may be strong in the resource space, some may be stronger in the global space, some may be stronger in the credit space. So it's ensuring that any manager that you pick has got that flair and skill set to be able to differentiate there. And then lastly is bringing it all together. Hedge funds are not homogenous. By being able to attract that, to be able to implement the diversification, we have, in our view, a lot more predictable process in delivering risk profiles. So by blending all of these strategies, we can deliver, and which we do offer in our range, a low risk hedge fund offering, which Adam mentioned earlier, living annuities, where you have the sequencing and drawdown and drawdown risk, because that is the nature of what people will be using their living annuity for. You do want something on the lower risk spectrum. Also for the more conservative clients, so they can go into our low risk multi-strategy solution. We increase the risk as we go up to a more capital appreciation as well as the need to draw from the portfolio. And then for those who are really looking to enhance portfolios, hedge funds can give that to you too. So it's important not to bucket a hedge fund in one specific way. The industry is diverse. Many houses have multiple risk profiles within the houses, but in terms of being able to enter into something that suits your clients' portfolios or be able to use it as a building block, I think hedge fund offers that key diversity, which you're not going to get just in the long only asset space. I think this is something that concerns us, and again, why we really play a part in looking through our underlying managers' positions is to make sure that conviction ideas come to the fore. Often when you are blending and you've got the multi-manager approach, when you're blending a few managers, one of your managers could have a great idea, but once you've blended all of that together, and you look at your portfolio and look through basis, there isn't much of an exposure beyond potentially, where they are in a bench, where that position would be in a benchmark. So what we try and focus on is ensuring that if there are ideas where managers have got high conviction, that our portfolios have enough exposure to be able to be rewarded for that. So, you don't want just this long tail of positions. Even though we are blending different strategies, different ideas, and different managers, there must be concentrated views in a risk-appropriate manner to deliver the returns that the client should be rewarded for. So now I'd like to go into how we think about this in a practical way and how we implement it. And I think one of the most prominent topics and thoughts over the last few months is China. And, you know, it's obviously such a massive market, given what's going on with trade tensions in the world, geopolitical concerns, the potential, is China going to invade Taiwan, overreach of the Chinese government in a quasi-capital society, capitalistic society where there's obviously a communist and social flair. Some people think, although it offers value, how can you actually expose client portfolios to that? We see it differently. You know, we see valuations which are relatively compelling, especially given where American markets have been. You know, you've heard Offrey talk about NVIDIA. And yes, there are obviously key instances where valuations might be rewarded. But when you've got a company like Apple, should it be on such an expensive multiple? But if you're looking at China, we see value as a destination, as a geography, as an economy, as, you know, population with 1 billion people. Headwinds definitely, but valuations are not compelling. So what would we do in this instance? For us is we want exposure, but implement it in a different manner. When you're in a long portfolio, you've got two choices: buy China or don't buy China, and that is your binary decision. In the hedge fund space, it is different. We can say we want to give our clients exposure to the Chinese market, and what we've done here is we've implemented exposure to China in what we've got a geared exposure, but with capital protection. So we've entered into a payoff profile, which is with one of the big banks, where you've got a 3.5-year term for this product. Your capital is protected. So if the worst happens, if we go into a global recession, if China invades Taiwan and is shunned the same way that Russia was with Ukraine, your capital is exposed to the counterparty in terms of the bank. So unless the bank goes under, you will get your capital back. But what we've got is geared upside to the portfolio. The upside is capped at 50%, but we've got 3 times gearing in that portfolio. So you can deliver a return where essentially, if you look at that over the 3.5-year period, the Chinese market would have to do 42% compound annually before we are capped out. But should the market only do 10%, clients will make 30% in that period. So for us, that asymmetry here is clearly depicted. Capital is protected. We've got exposure to a region that we think we don't have a crystal ball. We don't know that everything is going to pan out, but we think probabilistically there could be good return enhancement. The next way of doing it is in a more conservative manner, where I think, again, with the structured products that have become a little bit more mainstream in South Africa over the last few years, the auto call, which is quite an interesting instrument. Put simply, and not to spend too much time on it, how an auto call works is you get exposure to an instrument where if the underlying exposure, whether it be an index, a sector, you can even have it over a single share. In this instance, again, it's over China, and we thought in our more conservative portfolios this would be more applicable, where you don't know the outcome. But what we're doing here is we're saying we've got a constructive view on China. We think it will perform. But here, what we're saying is how auto call works is if the market is up from the moment you enter into the position, in 1 year time, the product auto calls and you'll get 11.25% return. If it is down after the first year, you've got the second year where if the market is up again from when you enter to the position, you'll again get 11.25%, but a simple interest on a compounding basis. You're going to be, let me just actually bring up a pointer for you here. On a compounding basis, that's 10.68% per annum. And so it goes on. Worst case scenario, in year 5, you get your capital back. So again, capital protection, but with a chance of returns. Now, looking at this, we can say, well, that the geared return is obviously much more attractive. But in our conservative portfolios, what we're looking at here and how we assimilate this information and go through it in our portfolio construction view is that if we're assuming that cash and JIBAR is around 7.5%, if this auto calls in the first year, you're getting cash plus 3.75%. If you compare that to bank senior paper, that's at 8.2%. So you're getting a significant pickup on JIBAR, you're getting a significant pickup on bank senior paper, and we are exposed to the bank senior paper should China just be positive in 1 year's time. So we think this is a very attractive payoff profile. Take that to the next level of where inflation currently is, and you're getting significant real returns out of an instrument like this, exposure to China and exposure to senior bank paper. Another trade that we've looked at and we have exposure to is South African banks. South African banks seem to be very well priced at the moment, strong dividend yields. However, we have had this risk of Trump and in its extreme sanctions, but at the worst, not as extreme sanctions, but just deteriorating trade organizations. So trade criteria. So for us, banks look cheap, but you've always got this risk that what could happen, and really where it played out is you actually saw it at the beginning of April, how quickly our banks did drop. So we haven't implemented this trade, but this is an idea of what we have been looking at. And if we take what we've got here, again, no crystal ball, this is an example of the mean analyst expectations in the darker line. In the darker line where the ABSA share price is, and in the light line where the analyst recommendations of the mean analyst recommendations of where ABSA should be or could be relative to all these analyst valuations, and you're seeing a 23.5% upside. That is a significant return in very well capitalized bank. So your choice is to be exposed to ABSA directly, but if you go and look at a put option, you can go and spend what we've priced here is a 95% put option, which is going to cost you 3.3% for the next 3 months. Now, given that your return potential is 23.5%, we're effectively saying here you've got 8.8% downside should the worst happen, and then your capital is protected. So a net return of 15%. Why are we looking at it only over a 3-month period? Because we think probably peak noise is going to happen now. Obviously, we've had the last night's interaction. I think, we're always learning in markets. I think what we realized last night is maybe we don't even have to spend 3.3% on a put option premium. We can just pay for a flight for our local PGA pro, send the golfer over there and mitigate that risk in a different manner. We're always learning. But on a serious note, it's a very affordable insurance premium given the return potential. Looking at different instruments and different asset classes, I touched earlier on our exposure to commodities. Commodities in South Africa are illiquid. There are not many pure soft commodity managers that trade on a listed exchange. But we fortunately have got an unbelievable manager who, in our view, has got a great skill set. He's one of a handful of commodity managers in South Africa. And by entering into our funds, not only are you getting exposure to the different asset classes that you'd be familiar with and strategies, but getting exposure to commodities just gives an additional form of alpha. So what we're showing here is just an interesting way of looking at something that we're not always familiar with. I mean, we might be familiar with it from a day-to-day inflation, etc., and what's going on with the prices. But our manager, one of the positions that he implemented towards the end of last year was an unbelievable trade. And again, he came to us, definitely was beating the drum. What a great opportunity this is. And it's quite a simple thesis when you look at it. You look at the work that is available. He looked at the planted area size, the crop size, what yield you were getting, what the beginning stock value was in the white maize, and essentially what the supply was in looking back over 2022, 23 to 24, and what was coming to 2025. And what you saw previously was a surplus for the 2022-23 year, as well as 23-24, but it seemed to be a deficit coming into this year. And if you go and look the actual trade that he implemented in a very short space of time, the white maize trade delivered significant return. Gave back a bit of profit in the end, but these are the types of strategies that we can be implemented. Now, again, because of the volatility and the nature of this, and there wasn't really a hedge around this, we're not going to have a massive and significant exposure to it in the portfolios. But at the right size, you're going to be able to deliver very attractive returns that the traditional long-only space, your traditional CISs are not going to be able to offer you. So, hopefully short and sweet, but in a nutshell, our multi-strategy funds give you that diversification. We believe they give you capital protection, and being able to enter into a very specific risk profile and understand that we've got a low risk offering, a moderate risk offering, and a high risk offering. You can cater to the needs of all of your clients, and importantly, put different forms of building blocks into your portfolios that you believe are appropriate. So whether it be into the lower equity funds, so your lower risk funds, what we're showing here is this is Korean Absolute, which has been running since 2001. Over the last 5 years, your risk return profile relative to a CISA low equity category average, as well as the All-B, you're getting significantly enhanced returns at much lower volatility than the All-B, and even lower volatility than the low equity category average. And if you want to step it up on the risk profile, looking at our more aggressive multi-strategy fund against the medium equity and high equity returns, once again, significant return enhancement, but at much lower risk. So the capability to be able to look at a different client set or different risk profile and add different building blocks to enhance your portfolios. That's it from my side. And once again, thank you for your time and your interest in hedge funds.
Thank you so much, Gareth. And again, I'm sorry, we've all been guilty of this, and unfortunately, MJ has the last slot, and we've eaten into the time budget progressively as we've gone along. So I'm so sorry, MJ, that we haven't left you with as much time as we ought to have. And so, unfortunately, again, we won't have time for questions. But if you can try and squeeze it in within the required time, MJ. And apologies again, we need to run a tighter ship amongst us all. Thank you so much.
Thanks, Adam. Just checking, can you guys see my screen?
Yeah, we can see the screen, hear you perfectly. So please go ahead.
Perfect. Thanks, everyone. Thanks for your time. Apologies for running a bit late. And thanks, Apex, BCI, FundRock, Tanya, Olga, Eugene, and the whole team. It's always a pleasure working with you and participating in these sessions. We really appreciate it. So what I'm not going to do today is tell you what a hedge fund is and what makes it different. This is the 4th webinar in this series. So please have a look on YouTube, sign up to BCI's marketing, and go look at these very informative sessions. What I am going to do today is talk specifically about multi-strategy funds, what's going on in the world, and why they use a different approach to generating returns and, importantly, managing risk. So just before I do that, briefly, for those of you not familiar with Fairtree, who don't know us, Fairtree is a leading global investment manager that operate a combination of long-only as well as alternative investment products across global asset classes. We've grown our AUM to 175 billion, and yeah, anecdotally, it's a great company to work for. So similarly, just our hedge fund track record, it's important to note, and we'd just like to highlight that Fairtree actually started as a hedge fund business. Our genesis was the market neutral fund, the first market neutral fund launched in SA by Andre Milan in 2003, and subsequently spun out and was the establishment and the genesis of Fairtree in 2006. I'm pretty proud of our track record, of which highlighted in orange, the Wild Fig Fund, which is our flagship multi-strategy fund, has been awarded 8 Hedge News Africa awards over time, and most recently during the 2024 awards, both the best single manager 5-year performance as well as 10-year performance. So just taking stock, allocators would agree we've been through some tough times recently, and I, for one, am pretty glad we sat here in the lovely wine country in SA, somewhere that doesn't rely on getting some of the best wines in the world being tariffed, because it's been quite volatile. And the reason for it is they say days feel like years and years feels like days. Well, the past 6 months has felt like 6 years. And since November to 2024, and the advent of Trump 2.0 and Besant's 3-point plan, a lot has changed in terms of global policy, trade, and hence growth and asset pricing dynamics. So setting that scene, let's jump in a bit. The US, they have a debt problem, and the main issue is this stems out of their reckless spending, and this is across administrations, fueling growth. As they try to fuel this growth, remember that debt to GDP is effectively a combination of both outstanding debt issuance as well as economic growth, right? So to stabilize growth, therefore, growth must outpace the cost of debt when nominal GDP exceeds the cost of financing. So effectively, if your interest rates are around 4%, your nominal GDP, which includes inflation, should ideally reach that 4%, hovering around 4 to 5%. And it helps when you have two things that supports this. You have a high growth environment driven by accommodative, stimulative fiscal policy as well as monetary policy. So in a low interest rate environment, you're able to finance that growth, finance that by that debt at rates close to zero. But interest rates have ballooned through a combination of both debt issuance, interest payments, through a combination of both debt issuance as well as higher interest rates, which we're well aware of. And this especially post-COVID and the higher inflationary environments we find ourselves in both during the Biden administration as well as the Trump administration. So nominally, the effect of this is the US will pay roughly $1.1 trillion in interest payments on their outstanding debt, which could and should likely have been repurposed into the economy. And what we can see is this is causing an execution problem. When looking at the interplay between fiscal and monetary policy, there's two levers effectively available to government in managing the economy. Generally, monetary policy is pro-cyclical. It's a balancing act. It's unemployment versus inflation, cutting rates versus increasing rates. And fiscal policy is used by a government as a tool to manage the budget deficit. Especially during recessions, it's a way of passing over money effectively from the public to the private sector and stimulating the economy. And as you can see on the graph, during these recessionary periods, highlighted in gray, the US would issue debt, effectively increase their debt. This is in orange, like I said, and it's inverse. So effectively, the declining rate is the budget deficit. So when the line decreases, it means the debt issuance increases, right? So at the moment, the budget deficit is already close to 7%. That's 6.98%, which is the highest in negative terms, even outside any recession and ex-COVID. It's the highest it's ever been. What this effectively implies is that if the US had a recession tomorrow, fiscal policy in the US is in the worst position it's been in history, with limited room to support the economy. And similarly, monetary policy and the Fed has limited scope to actually support the economy by cutting rates on the back of persistent inflation due to the changing policy environment that we find ourselves in. And the effect of this is it's causing a confidence problem. So the US is losing its credibility points. Confidence in the economy is failing, and Mr. Market is taking notice. And we see this by the rising term premium, which reflects a weaker policy credibility and confidence in the economy and their effective ability to support the economy if needed. And the term premium is generally, it's the premium investors pay and demand for long-term treasuries versus just rolling short-term treasuries. And you can see that's increased since 2020, but also subsequently increased during a rate cutting period. So as the Fed started cutting rates towards the back end of last year, treasury yields actually rose, as you can see by the orange line, the US 10-year treasury. So there was no easing into the economy, which is a market anomaly. The 100 basis points cuts effectively led to 100 basis points increase in yields. And since has actually breached that number and continued to rise during the policy environment we find ourselves in. So this is causing effectively historical level of high volatility in the markets across all asset classes. This is the VIX, the MOVE, as well as the currency index, and also policy uncertainty. So there's an uncertainty problem, and it's shooting through the roof, both globally and in terms of local US trade. The result in subsequently, along with confidence is, uncertainty is a confidence problem. And this is being led by consumer confidence. So the consumers have less confidence in the US economy and their ability to support the US consumer during periods of drawdowns and drops in the economy. And this is driven by an expectation problem. So the result of a higher inflationary environment are expectations of higher cost pressures across the board. And to explain this graph, it's a chart of Fed manufacturing pricing surveys, which is real economic data. So pricing surveys experience in terms of manufacturing, which is a 6-month leading trend and a 6-month leading indicator. And it's trending higher, as you can see in the block, with the green line being actual PCE, which is a lagging indicator closely following. And the expectation is there's a term for a rising inflationary environment with a subsequently slowing growth environment, and that's called stagflation. So stagflation, and during these stagflationary periods, assets tend to underperform, both in terms of yields and bonds and as well as stocks. The perceived trade-off between recessionary risk and inflation, they are the drivers of the stock-bond correlation, essentially. So when a recession is more of a concern than an inflationary spike, bond yields in the stock market exhibit a positive correlation. However, when the inflation spike is bigger concern than the recession, stocks and bonds exhibit a negative correlation, which was the case in 2024. But as you can see, even during these periods of significant stress, as you can see on the chart on the left, the 3-day rolling drop in the S&P since on the day of the April tariff announcements, the Liberation Day, or known as Demolition Day, that drop was on par with major drops in the stock market, the GFC, COVID, etc. Whereas during that period where the stock market actually dropped, yields only dropped 19% and subsequently bounced back immediately and having kept rising since. And this is due to a combination of a loss of confidence in the US and the expectations around the inflationary environment. The chart on the right shows there's little to no relationship with the stock-bond correlation between the stock-bond correlation when CPI, where inflation is under 2.5%, so that's that circle towards the left. However, when inflation starts to increase and it prints higher, the relationship breaks down and equities don't serve as a hedge for portfolios anymore. And we've seen this. This is causing a portfolio problem. It's especially within balanced constructs, so retirement products or a rational investor having a balanced view in terms of his portfolio construction. Equity bond combinations have been breaking down, and this is a 60-40 portfolio, the traditional balanced portfolio, where you can see that the growth has essentially gone nowhere since the beginning of 2022, a annual 2% real return on a 60-40 portfolio. And the blue line and the black line is the constituents of a 60-40 portfolio. So what does this mean? What does this mean for investors? What does this mean for portfolios? And how do we take stock? Well, how do we find not only diversification, but also differentiation? Because this is something we've seen quite commonly in financial markets. When markets break down, investors think they're diversified. But what do you do when diversification isn't effective and volatility is systematically higher? This is quite limited from our perspective in the long-only space. And obviously, this is why we make a case for hedge funds. It's not anyone's fault. It's purely the mechanics of long-only products. We as an investment house, we have a very successful line of long-only products. But due to the regulation that governs them and the tool set available to them, effectively, the long-only space lacks efficient diversification. We're looking at 30 SA general equity funds and diversifying across these funds, your correlation remains effectively above 90%. So the chart on the left is a portfolio where you diversify from one portfolio or one of these funds up to 30 portfolios on an equal basis. And you can see that the correlation as well as the effective effect on volatility remains quite flat. Subsequently, and compared to an actual diversified portfolio, when you adequately diversify to differentiated products, the magic of portfolio theory really happens. And as you can see, both on a correlation basis on the left and as well as volatility, when you diversify to different portfolios, so they differentiated portfolios, thereby implying uncorrelated portfolios or assets that act differently during the same market environment. It's not only different managers or the same asset classes, but different categories as well as dynamics of the distribution of returns. You see that you get effective diversification. And that essentially is the benefit of hedge funds. That is what we aspire to deliver to clients. And the graphs and tables on the chart, they're quite complex. I don't think we have time to run through all of them, but you're more than welcome to do that on your own time. What I'd just like to highlight is the two at the bottom, where you can see is as you increase the number of strategies or assets, as well as drop the correlation between them, you can see that portfolio risk significantly decreases when adding these strategies or assets up to 5 as an example, as well as the portfolio Sharpe ratio, the chart on the bottom right. You can see that the Sharpe ratio significantly increases when you add these individual strategies or assets with uncorrelated return series. And that's the benefit in terms of portfolio construction. And that is the benefit and why we've built and constructed the WildFig Multi-Strategy Fund. So what is a WildFig Fund? Just briefly, it's similar to a balanced fund in terms of a long-only product being a balanced composition, whereas the WildFig Multi-Strategy is a hedge fund, and it's a blend of internal fair trade, uncorrelated hedge fund strategies. And it aspires, and the objective is, to generate an absolute return during all market environments, but targeting JSE volatility, and that's important. Its inception is August 2010. Like I said, the biggest component is that market neutral asset allocation sleeve, which was launched in 2003. So it's got a long-standing track record. And since inception, the performance has been generated close to 21% per annum. It goes without saying, all these numbers and figures are after all subsequent fees. So that's a net performance number. Correlation, importantly, it's at 0.45 to the JSE. So it has an effective place in portfolio construction in terms of diversifying your portfolio. The team, I'll get to the team slide now. And just out of a point of interest, Fair Trade collectively is the largest investor in this product. Investment philosophy is built upon 3 pillars: asset allocation, the blend of the return streams and how we blend them in terms of strategic asset allocation. Portfolio construction is how we allocate to these independent asset classes within Fair Trade, and then risk management is what we do daily, is how we track and monitor the portfolio metrics on a daily basis and on a see-through basis. The team, like I said, we're a team in terms of portfolio management, 5 of us running the WildFig construct. We're responsible for asset allocation, portfolio construction, risk management on a daily basis. But collectively, when investing in the WildFig product, you actually invest in the best of Fair Trade, the amalgamated view of Fair Trade, which is a collective 43 investment professionals across 3 asset class buckets: equity, fixed income, and soft commodities. In terms of SAA, the composition is a blend between, like I said, 3 asset classes: equity, fixed income, commodities. But we have 6 underlying strategies: equity market neutral, equity directional, global equity, which is market neutral, fixed income macro, fixed income quantitative, the 2 fixed income strategies, as well as commodities, a soft commodity strategy. So important to note, that's different to a high risk or a hard commodity strategy, things like oil, PGMs, platinum, etc. We invest in a soft commodities strategy, similar to the slide that Gareth shared, which operates in the agricultural space, things like soy, wheat, cattle, beans, etc. And currently, we're invested and allocated to 18 sub-strategies, which we mature, develop, and all internal to Fair Trade, and we blend the composition thereof effectively as a portfolio management team. Just quickly on the right, that's the attribution. It's just important to note that across all 3 asset classes, they've all contributed to the portfolio net attribution over time. So there's been no detractors over time. So just a brief look into why a multi-strategy fund, how does it compare to a fund of fund, etc. It goes without saying, I think most of us would be aware that a long-only product essentially has 100% exposure to a single strategy. Compared to that, there's been diversification into blended products, balanced funds, which allocates to equity as well as fixed income, and a fund of fund products, which we've seen some of them on this call. A great product suite, just different to WildFig because they allocate to different funds, external fund managers. WildFig, on the other hand, internally uses a blend of all Fair Trade managers to allocate on balance sheet. So it's all within a single construct. It's all within a WildFig fund. It's not within different funds. It's a single point of entry. And we manage that uncorrelated blend of capital allocation. This allows, different to other products, for dynamic capital allocation. We can change any allocation or weighting immediately. And this allows for greater risk control as well as reduced fees because of the underlying strategy composition not being to external fund managers charging their own fees. It's a amalgamated blended fee on the single product entry point being the WildFig fund. What is that composition? Just taking a brief look under the hood. These are the strategies we allocate to. The highest, you'll see that they've all generated positive returns over time, some more than others, different risk profiles, but it's important to note that correlation, that blend, the highest being 0.37. So it's low correlation strategies blended into the WildFig construct with a correlation of close to 0.445. And what's this achieved over time? This is the risk return dynamics. And this is a 10-year scatter plot. It's just an overview of the relative position of WildFig. Essentially, like we said, it targets JSE volatility. So it's in line with the JSE, and it is adequate for investors looking to gain exposure to JSE volatility, not risk. Risk we define and see as the risk of capital loss, the risk of drawdown, so losing your position over time. But if you're willing to stomach the volatility and how you generate those returns over time, the Fairtree Wild Fig product has over time generated close to double the return that the JSE has generated for investors. So over time, that goes without saying, this excess return over time since inception, it compounds over time. And you'll see that's the chart on the right, the total return since inception, which is close to 1,500%. Risk and return dynamics on the left, you can go through those when we share the slides. What I'd like to do is just talk briefly in terms of how we actually generate those returns. And that is the magic sauce within the Fairtree product, as well as generally within a multi-strategy construct. And it's all about the distribution of returns and the uncorrelated nature of these returns. So this slide is just a snapshot in time since launching our daily price product, which is the RIF, all the returns of all the underlying strategies over time. And it looks quite chaotic, doesn't it? It looks like a spread of returns with no real pattern. But as you start analyzing these returns, a pattern and shape does take place. As you can see, the chart indicates the moving average of both the JSE as well as the Wild Fig over time, with the green dots being the alpha generated in addition, in excess of the JSE. But the blue line is that alpha compounding over time. And as you can see, what we try and do is generate small, incremental, daily outperformance as much as we can, as frequently as possible, which builds to a significant outperformance in the fullness of time. So small daily wins. But what that sums to, what this distribution effectively does, and a similar chart has been showed by some of the other presenters, is it captures the upside while minimizing the downside. So if Wild Fig effectively, the bar chart on the left, has a higher percentage of positive months versus the JSE in the black. But in terms of average size of returns and distribution of how we generate those returns, you'll see we have a higher percentage of positive returns, so positive monthly up returns, a lower percentage of down months, or down returns. So we actually minimize the drawdown as well and capture less of that downside. And the result thereof is, on average, it's a small incremental outperformance on a daily and monthly basis. And the shape of those returns is just as important. So this is called the distribution of return dynamics. So what we look here is, what we look at here is the kurtosis, or the shape or the skew of the returns. And not to go into too much detail, but what you can see is the peak of the Wild Fig returns indicated in orange centralizes around the sort of central theme of the return series. So it's less of the outlier returns and generally smaller size returns around the mean, but it's slightly skewed technically to the left. But as you can see, it's slightly skewed in terms of generating how we generate those returns to the positive side of the graph. So there's a smaller indication of higher outperformance versus negative performance. And that's the two moving averages lines, linear averages, as you can see. What I've just done is highlighted in the two blocks, the block in the green showing there's a lower downside, so the lower capturing of the downside, the Wild Fig line being the orange line, whilst we also capture more of the upside, the average to the positive side of the mean distribution being slightly higher than the JSE. And how do we do this? Well, this is due to the powerful force, the blended correlation of uncorrelated underlying returns. This is the daily 60-day rolling correlation, which we track internally of all our asset classes. And as you can see, across the three categories, fixed income, commodities, and equity, they oscillate around zero. So there's a low level of correlation between all the asset class buckets and internally to the sub-strategies to which we allocate. And this has been referred to by Ray Dalio, as he pointed out, as the holy grail of investing. I hope you're familiar with the term, but if not, what he tried to indicate is with this chart, which he shared in his principles research, is a combination of uncorrelated return series over time lowers the portfolio standard deviation or risk by achieving the same expected return. So what you can see on this chart is even if you increase the number of assets, the subsequent value of the benefit in terms of reducing risk, it diminishes over time. As you can see, the line sort of flattens out. But the different lines indicate different levels of correlation. So as you move down or lower in terms of correlation between these asset classes, you get the real benefit in terms of portfolio upside, same return profile, but lower risk. And what we've done, and I've shown this before, is we've used a Monte Carlo simulation to test this, which is a probabilistic tool. It essentially models and simulates the most probable outcome of a return series or data set. And what you can see with this is it's a model, a simulation of a portfolio, a single strategy with a Sharpe ratio of 0.5, so generally average, with a 14% annualized volatility number. So that standard deviation number is 14%. And over time, that generates a positive return. There's been some bumps and bruises along the way, but it's achieved a 7.4% annual return over time. But interestingly enough, is when you blend the same inputs, the same metrics into 20 different strategies or 20 different assets into a single multi-strategy fund, which we can refer to, but at a correlation of 0.4, so that's 0.4 correlation. It's similar to the wild fig correlation. You get the benefit on multi-strat level that the combination, the amalgamation, or the average of all these strategies outperform every single individual strategy, generating 11.8% portfolio return over time per annum at a higher Sharpe of 0.8. But the real secret is at a lowest correlation or lower correlation of 0.01. The results are extraordinary. It goes without saying. The portfolio generates a return of 36.2, excess of 30%, the portfolio Sharpe of 2.2. And the reason is this oscillating return series of uncorrelated returns at a very low correlation means you capture all the upside, it compounds and builds up, where you diminish the downside through means of the uncorrelated drawdown protection by essentially negating the downside through another positive return through a different series, right? And that essentially is the goal of adding hedge funds to your portfolio. The goal of multi-strategy portfolios is how we blend and achieve this uncorrelated return series. And that's the goal of portfolio construction at the end of the day. It's not only diversification, it's differentiation by diversification, which results in a higher return and a lower risk. And that, in our opinion, it makes the case for hedge funds and specifically multi-strategy hedge funds. So thank you.
Thank you so much, MJ. And you can see both, I think, from the Korean Capital presentation and in fact our own presentation, the powers of diversification within hedge funds. I'm respectful of everybody's time, especially the audience. I have one not a question, if I can read it, but I'd like to compliment Gareth's presentation. Very unique and enjoyable. Thank you everyone for the valuable insights. I echo that. Just thanks once again to the FundRock and the BCI team. It's a great privilege and an honor to host this event or to moderate this event. And thank you very much to all the contributors. I hope the audience found it as interesting as I did, as we all did, and that you can see very clearly the benefits of using hedge funds. Thank you. Have a great day and good investing out there.